Hi, once again, everybody. Welcome back to the Comstock channel. I'm Marlin Bohling with you, and I'm pleased to be joined by Joe Camp of Comstock Investments. We're going to be talking about how we put the wraps on this trading week. Be sure to like this video, subscribe to it, hit that bell icon down below, and get notified when we have new updates. You want to stay in the know. Also, share this video with others as well. Okay, Joe, as we look back on the week that just closed up here, to say it was an eventful week would be a colossal understatement, especially on the livestock side. I guess that probably got the gold star overall for the biggest move, didn't it?
Absolutely. When you look at the fallout here on Friday afternoon, slipping lower to a new low for the week, and that accelerated the selling so that ultimately April live cattle futures were down 675 for the week. We had May feeders off by just more than $10, 10.52, I believe, here over the 5 sessions, and that on further worry about this bird flu story. It's that being the trigger here for continued speculative liquidation. We talk about those hedge funds that had been building up bullish bets in the cattle market for the last 2.5 months or so, and seeing a news item like this and now rushing for the exit again into the weekend with some of the technical softness, ultimately saying I need to get out of the way here before we get into next week, and we'll see what happens then. Now, we can still be reminded at where we're leaving the week, which is with a board that's now sharply discounted to the cash trade, and we think that's a source of support going forward from here. But to see the liquidation event that followed this bird flu story these last 2 weeks, week and a half, really, another downdraft for that market.
Well, I was looking at a feeder cattle chart at the end of the day on Friday, and it looks like it's getting really all of a sudden oversold. But when you have a situation like that with the HPAI situation, I don't know if charts really mean anything because it changes the entire market psychology, right?
Certainly there was an opportunity to maybe see some cooler heads prevail type rebound in this market, and we did observe a bit of that to start out the week. Ultimately, though, if you do look at that feeder chart that you mentioned, the May contract started Friday morning exactly under its 100-day moving average. No upside follow through early on, and so we started to move lower and lower. Once we fell to new lows for the move, selling accelerated. You ran through some additional stops, and you also poked into a key territory where we had some highs from early in January and that were coinciding with important lows on the chart from late November. So we're now into that level where if we fall any further, it's going to potentially be a quick move down to the December lows, which are still a ways away.
On the other hand, if you look at lean hogs, it looks to me like they made they took out the recent long-term high. Now you have to go all the way back to over a year before you find anything higher than where we are right now. They've had quite a run.
Yep, trading above where they were for basically all of last year. You have, I think, some strength linked to the weakness in beef, some benefit there of the spread action that had lifted hogs here over these last couple of weeks while cattle were going lower. But just generally, the fundamental storyline positive. We think back to Thursday as we left last week, quarterly hogs and pigs report that was rather bearish relative to expectations, but that being shrugged off in favor of a focus on what was also in that report, the more friendly forward-looking numbers of decreased farrowing intentions, still the knowledge that we're going to decrease overall production here into the second half of 2024. The fact that the last cold storage report had pork inventories down 12% from a year ago and at levels that are awfully low heading into a summer season when domestic demand is pretty good and still complemented by basically record strong export demand. So all of that still pretty bullish for this hog market, and we saw that play out again here on Friday.
How much of this do you think is related to, as I mentioned, the psychology of the market, that they think the consumer is going to switch from beef to pork now, and they want to kind of jump ahead of the wagon a little bit there and maybe beat them to the punch. Do you think that's actually going to be the case at the retail counters now?
I don't think it's going to be the case in a big way, but it is a reason that I can see for spooking some of those speculators that we talked about. It's one among the list of reasons that we talk about that would say, hey, this is just a source of uncertainty that I don't want to get in the way of what I'm holding in terms of profit that had been built up on this recent couple of month run higher. And so I'm going to step out and see what news brings us here, whether it's talk about consumers being a little bit spooked by this on beef, whether it's about further restrictions on movement like we got a taste of here this week to worry the market Wednesday, whether it's talk about more of a threat for people catching this or other animals. And so for that reason, it's just a reason to step out. Again, we're going to, back to how you start the question of is it just a speculative sort of reset? And in a big way, I think it is, because we talk about this, that there's a difference in the supply and demand for futures and the supply and demand for the underlying physical. Now, eventually they're going to come together, but we're seeing a reset that's sparked by this speculative liquidation. Eventually, I think we can start to see again this convergence higher towards stronger cash markets, because as mentioned, cattle in particular now, both live and feeder cattle, looking at discounts to the cash trade or the feeder index by $8, $9, $10.
Now, you and I were talking a little bit before we started this podcast here, and there was some data that came out from the government that was jobs related this week. And that has kind of stirred up some things in the equity, the financial markets here this past week. And I keep hearing more and more talk about inflation again. A lot of folks were thinking maybe we could have some drops in the interest rate values as we move forward, at least by the Fed. And now I don't know. How do you read the tea leaves when it comes to the economy?
All of that you mentioned is coming into play in such a big way. And it was noticed this week as we started off mostly lower here for the grains. On Wednesday, we caught a bid and rebounded in a large part, I believe, because the dollar index was so sharply lower and because we were focused again on this inflation problem. It shouldn't be lost on us that we're seeing gold make new highs after new highs, including again today, a new all-time high for gold prices. And that has something to say about the inflation issue we're still dealing with. And the jobs report this morning was strong. And sometimes good news for the economy is bad news for the market in terms of it potentially giving the green light for the Fed to keep interest rates higher for longer. And that was part of the initial reaction. But again, gold went higher anyway, even with odds reduced slightly for having our first interest rate reduction in June. The idea is that we're still going to have an issue with inflation because in part, strong jobs mean still strong wages for the most part. And that's an inflationary pressure that should lift these commodities like gold and oil. And to mention too, a big deal here is something that got into the wheat market as well, ongoing global security risks that would spike items like gold and oil. And that's something I wrote the Comstock report about here to finish up the week, that gold and oil, for not only the inflationary risks, but also because of what's going on abroad with the war in Ukraine and Israel's war on terrorism, the provocations with Iran here all of a sudden, gold and oil can be commodities that lead the rest of the space higher here through the rest of 2024. And I'm not alone in that thought here. We have outlook research from big banks like Goldman Sachs and Bank of America calling it that way as well. So I'm going to watch for that, the potential for the grains to catch up in a way after starting the year lower with a commodity space that's holding some gains for the year so far.
To that end, you have put together a commodity performance chart, and I thought that was really intriguing. And we're going to talk about the grain sector here in a second. And the first thing I noticed was on that chart, the poorest performers on there are the grains. They're like way at the bottom of the chart. The highest performers are some of the maybe lesser known commodities among the farm community here. But like you said, gold, cocoa, was a big performer and that sort of thing. And it really has tilted the scale in that favor for the time being. Explain this chart here.
Yeah, we can start at the top. As you mentioned, cocoa, that's been a huge story for commodity traders because of its breakneck rally. We talked about cocoa prices hitting new highs and then doubling from there. And it can be an example of what happens when you get a hold of a weather market that's bullish, like it is for cocoa, some rough conditions as of late in the top producing countries of Ghana and Ivory Coast there in West Africa. We think about that as something that is still seasonally potentially a source of support for the grains that we normally get into the months of April, May, June and have some concern about the season ahead, whether it's too dry or too wet. But for now, the grains are lagging. And if we bring up where we're at in the, somewhat top upper middle for the rest of the commodities as a whole, and the commodity index, which I mentioned, being up about 11 or 12% since the start of the year, that's a lot of room that these grains can catch up. If we refer back to what I mentioned, some of these bigger banks, Goldman Sachs doing a study that the historical tendency is for the grains included to have a positive year when you have interest rates falling like we're expected to do later this summer. And I think that's key here that commodities like gold and oil and those at the top of the list can ultimately pave the way for a better outlook going forward for our agricultural prices, which, as you mentioned, as you can see on the chart, are for now at the bottom of the list here.
Well, we did have a fairly strong finish on the wheat trade as we got to the end of the week there. That one has been the laggard for many, many months now. What is it that caught the attention of the wheat traders?
We can go back to that mention of global security risks for one and think that that's coming into play in a bigger way here this week again, and yet even more on Friday as there was news about Ukraine launching a huge drone attack on Russia's air fleet. There has been in the news a lot of talk about Ukraine targeting Russia's oil infrastructure and certain refineries. And no matter what, we know that there's an elevated risk all of a sudden, and some examples of this where Russia is subject to retaliate against Ukraine's grain infrastructure and their shipping assets around the Black Sea, which would absolutely put disruption for the wheat trade in play here. And just in general, there's also support here from Russian prices as a whole, wheat starting to move a bit higher after recently probing to a severe low under $200 a ton. They're up about $15 from their late February lows, and there's some signs of that pressure easing from the global market to help allow wheat to potentially move higher from here. The overall outlook is for world wheat stocks as a whole to begin moving lower towards the end of this year. And as much as we've gone down for that market since the initial spike following the invasion of Ukraine, there should be a possibility we start to see some upside, and wheat can become a leader for corn. It can generally take some pressure off of the market after it's been such an anchor for so long.
After the planning intentions report came out, that was on March 28th, it seemed to be friendly for the corn market and maybe bearish for the soybean trade because they expected fewer acres of corn. On the other hand, since that came out, conditions look pretty favorable for planting season here in the U.S. Midwest, especially if you look at the 6 to 10 day forecasts. And I've already seen quite a few farmers planting corn in the last week or so already. That would be in the Mid-South region. But all in all, I mean, it looks like things may get off to a pretty good start. I don't see too much of a lack of moisture.
No, you can bring up that 6 to 10 day outlook and observe it for the most part drying out, especially across the Western Corn Belt, where they had just come off of the Easter weekend and having a really strong dose of moisture. It doesn't cure the drought that's still in pockets of Eastern Iowa or other places throughout the Midwest, but it does go a long way in setting us up for a better start to the new planting campaign here, where we're going to have some worries is potentially down in the southern states. Now, any moisture is going to be welcome in the southern plains after the years of drought that they've been through. But more concerning in the immediate period would be the excessive rainfall throughout the Delta. And you can also see that on the 2-week outlook map. Some really heavy showers following up what are some pretty heavy rains falling here into the weekend. And that's an area where they'd like to get started on planning. Anytime we talk about potential planning delays and it's, within the first 5 days of April, like we're at now in the Midwest, then we're going to be laughed at. It's way too early, but it's not, in some of those states across the Delta. And that can come into play where maybe we edge a little bit back on this worry that corn acres just have to go up from that March report we had last week. Because they'd like to get going here in the Delta, and there is a continued outlook for that region to stay pretty wet. Now, it's a long time from now where we could start to have wetter weather disrupt production or harvest efforts, but that's one thing I'll look at as well, is that this expected shift that we're going through from an El Nino to a La Nina does keep that southeastern region awfully wet, and I wonder if this is just the beginning of what's still to come with some actually excessive water issues this season. But elsewhere, mostly favorable, and that did lead to some backtracking after the friendly acres report last week.
Well, the ball and chain on the grain market still seems to be the export sales, right?
Yes, and we observed that this week with the weekly report, all around pretty disappointing. I think you look at corn exports and you got a lot more to be positive about. We're going to be up on the year quite considerably, not thanks to China. It should be mentioned. We've got our top partners, Mexico, Japan, this year Colombia, but we don't have that demand from China. If anything, that could still be, though, a story on the margin if China begins to buy U.S. corn, say, because they're a little bit concerned about availability or rising prices in Brazil. Still to be reckoned with would be what we think should be lower estimates for that Brazilian crop here coming off of a dry season. Still a lot ahead for the safrinha corn down there. I preview what's ahead towards next week, which would be the monthly WASDE report, where we should expect to see some movement lower on those Brazilian production estimates. But overall, we're seeing that exports are a bit negative. For soybeans, something I want to bring up here this week, with all the disappointment there, I think a silver lining could be shown in a chart I prepared about unshipped soybean export sales, and that they're at a rather minimal level, which means, in my mind, we're less at risk of cancellations like we often fear about heading later into the summer. We don't have much still to ship out. We're likely to come close to meeting the USDA export target anyway, and so that could be a silver lining in what is ultimately still a bit of a disappointing export picture. And I got to say, too, for soybeans, we can't export as much as we have in years past because we're crushing record amounts of them. And that's what ultimately helped us higher at the close here for soybeans on Friday, would be that crude oil is higher again. Soybean oil is higher again. We're really crushing soybeans, and we don't have a lot left extra for the export market, at least right now.
Do you think that'll come back down, though, if Argentina comes back online with their crop?
That'll certainly be an impact for the meal market, and that was felt here as of late, some spreading, meal actually finishing a bit lower here to end the week. So if we do build up excess meal supplies, that could be a limiting factor, but lately we're talking about still crushing the bean for the oil. And if crude oil is going to march higher, like we talked about, for inflationary reasons and the global security risk, Bank of America calling for crude oil peaking at up to $95 here this summer, that's going to be pain at the pump, but it's also going to be a source of support for these processing margins in an expanding renewable diesel program that I think still leans bullish overall for that market.
Next week, we get the April WASDE report. That'll be out on April 11th. That'll be out at noon Eastern time, 11 o'clock Central time. Is April usually a market mover, or is that kind of a yawner?
Usually a yawner, but more important for what we still are waiting for, and insofar as those expected cuts for the Brazilian crop estimates in particular. Brazil's CONAB agency will come out that morning with their updated estimates. if they're anywhere close to where they were last month, that'll still leave a gap of way over 500 million bushels between them and the USDA on this year's soybean crop plus last year's soybean crop in Brazil. And so that could be a source of bullishness out of this April report, and what is otherwise usually a more quiet one, because on the U.S. side, we could see some demand revisions here or there, ethanol or soybean crush or exports, but we have to wait until May until we get that first look at the balance sheet for the new crop numbers. And for that reason, that's why sometimes April is a pretty quiet one.
And I would imagine by the time that report comes out, we'll have a whole bunch of corn and soybeans already in the ground for this year. So it's going to be a busy week. We'll have to get geared up for that. All right. Well, thank you, Joe, for talking with us. Always a pleasure. Joe Camp of Comstock Investments with us as we take a look back on the week that was in the ag commodity trade. Appreciate you joining us. That'll do it for this episode. For producer Breanne Hendrickson, I'm Marlin Bohling. Catch you next time on the Comstock channel. Thanks for joining us on our Comstock YouTube channel. Don't forget you can also find us on Facebook and TikTok as well. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.